Good day. Welcome to another episode of Dave's Desk. I'm Dave, and this is where we do a deep dive into the statistics of the Ottawa real estate market and talk about what's really going on. The last time we did one of these was back in July, and the market has continued to change since then. So let's dive right into the latest statistics posted by the Ottawa Real Estate Board. So it shows that we sold a total of 987 homes last month, which is much lower than recent years, but not the five, and actually much different than the 5 year average too. 1,554 is the average for October over the last 5 years, and so 987 quite low in that regard. If we look at pricing and inventory, so inventory right now, the residential class, we have around 3.3 months of inventory. That's actually pretty healthy. That when we looked at this 6 months ago, 12 months ago, of course, we had ridiculously low inventory levels. And so this is actually a positive sign. This is a healthy sign. And this is an indication that we're moving back towards a balanced market. And a reminder, a balanced market, in my opinion, should be about 3 to 4 months of inventory. So we're right in that sweet zone. And I think that's a healthy thing for buyers and for sellers. If we look at the condo class, it's similar to 3 months inventory. So I'd say that's healthy levels of inventory for both residential and condominium. If we look at pricing, the average sale price of a condo is just under 446. That says an increase of 9%. We're going to talk about that more in a second. And then the average sale price of a residential is just under 678. That's a decrease of 5% from a year ago. They also are quick to point out the year-to-date averages of 780 and 456 represent an increase of 8% and a 9% respectively. So this makes it look better than it actually is, in my opinion, and that's because, let's jump to it right now. If we look at the actual numbers, like the actual pricing, you'll see that average sale price, this is including residential and condominium, it prices, and again, the green line is the 2022 numbers. It really jumped up, and about February or March is where they peaked. And so, and they've been steadily declining since the peak in about March of 2022. So when they say there's still an increase of 8%, well, you kind of look at the graph and say, how can you make that claim? And it's because, well, this dot is 8% higher than it was at the beginning of the month. Where this is really going to tell, though, like if you truncated the data to March, it would show a much different story, probably like a minus 20%, like a decrease in average sales price by closer to 20%. And it's just that the first 2-3 months of 2022 is still keeping the averages high. So there's so when they tell us, here's the story here, the numbers, the closer look, the deeper look is to understand that prices peaked in February and March, and they have been steadily declining ever since. And roughly we are, if you look at the green line, it's roughly where the red line was, which was last year's prices. So essentially we have undone all the late 2021 appreciation, and any appreciation in those first few months of 2022, that's all been wiped out by the price reductions since March, the decline in price. So we're roughly where we were a year ago. Still higher than pre-pandemic for sure. We're still significantly higher than pre-pandemic, and here I'm hopeful that the prices are stabilizing out here. We haven't seen them any sharp declines in recent weeks or months. We haven't seen them go back much upwards at all either. So, and we're going to talk a little bit more about forecasting the future, what's in store for us ahead. So there's a quick update on inventory. I'd say inventory levels are actually healthy. I think this is a better environment for both buyers and sellers. We're back to a market where you can negotiate, where the sellers, of course, are going to set their asking price, and then the buyers are going to come in with their bid price, and sometimes there's a gap, and you have to negotiate back and forth, and you try to land on a number in the middle. And I think that is a healthy way of negotiating, not like a year ago where it was sellers set the price here and everyone just kind of has to guesstimate on how much higher you have to go. So those days are over, and we're back to a more traditional, healthy market, more balanced market for negotiating. Average days on market right now, I think we're closer to 40 days. Again, that is a healthy length of time for a home to result in a successful sale. So, and we're also seeing conditions are acceptable to put conditions back into our offers. So I think that's healthy for buyers. It's very reasonable when they're making one of the largest financial decisions of their life to be able to put a home inspection condition in. And so we're back to an environment where that's acceptable, and I think that's a good thing. Same with financing conditions or any other conditions that may be appropriate for the transaction. And we're even seeing a few times conditions on the sale of another home, kind of like a domino effect, where I'll buy this one provided I can sell mine. And anyway, that's called a condition to sell another home, and they often carry a first right of refusal. Well, that's not the subject today, but the point being is conditions are now a thing in traditional negotiating again. Okay, so there's the pricing. So, and that's basically a snapshot of where we are today. If we were to try to look ahead and where are things going, we have a lot of resources that we can draw on. Before we jump too far into though, we have to kind of discuss some of the obvious things, some of the big changes from the beginning of the year to today. And in fact, I think I have another slide for us. Let's look here. So if you had gone to the bank and you got a mortgage pre-approval in the first quarter of 2022, you probably were quoted a rate in around 4.15%. And assuming you had 10% down and you had a purchase or a mortgage payment affordability of $37.87, you would have been buying something maybe around $764. That would have got you a really nice brand new almost townhome in many suburbs, or perhaps it was a slightly more distressed single family home in around that price range. And that was the going rates, at the beginning of Q1. And that was at these rates, and at that rate, here's your mortgage payment. So, many people were buying, that was around the average sale price at the time. So these were realistic numbers at that time, beginning of Q1 2022. But of course, the Bank of Canada has increased their interest rates many times since then. They have 8 announcements scheduled every year, and most of those, if not all of them this year, I think, have included some kind of interest rate increase, so much so that we're now, if you were to go to the bank and ask for a similar mortgage pre-approval, you'll probably be quoted something closer to 5.4. So a big jump in interest rates from 4.15 to roughly 5.4, give or take. But the point is, if you're the same family in Q1, this is what you could have afforded, $37.87. Now fast forward, we're at the last part of 2022, you can still afford the same mortgage payment, $37.87, but because of the interest rate, your purchasing power has gone from $764 down to $675,000. You've lost $89,000 in purchasing power, or that's down 11.6%. So that really helps to connect what's happening here. This is for sure one of the biggest driving forces of why prices have gone down so much in Ottawa and other markets is because of buyer affordability. Buyers cannot afford the same mortgage as they could 9 months ago, 12 months ago. And so this is biting in directly into their affordability, and that's definitely having an impact on the sales price, as we already discussed in these graphs. So that's important to understand. Now, of course, why is the Bank of Canada increasing the interest rate so much? And if you look at my video in July, and it's not just me, but many economists, not that I'm an economist, but most opinions were that, we're going to see some increases, but I don't think anyone envisioned so much dramatic increases in interest rates. No one would have guessed, I think, 9 months ago that we would have had to go up by this much. I mean, that was unprecedented if you look back at the history of interest rates changes. Normally, they're very slow to change interest, and this is rather radical and quick. And of course, that is all a result of inflation. So we all seen inflation. We see it at the store. We see it at the gas pumps. We see it everywhere in our world, certainly in real estate included. That prices were kept going up and up and up. Everything is more expensive, and this is often measured by the CPI, Consumer Price Index. It's a tool used by StatsCan government and the government of Canada to measure inflation. And we saw those numbers escalate. I think their target is to keep it between 1% and 3% per annum, and it was jumping in close to 9%. And so when you look at this is a report published by the Canadian Mortgage Housing Corporation, fantastic resource for real estate in Canada. This was published back in October 13, 2022, and there's some really interesting key points here. But basically, everyone agrees that the inflationary pressures were stronger and more persistent than expected. And basically, they had to take more drastic monetary policy changes than anyone imagined. And that meaning they've increased interest rates by so much. So that really is the driving force here. You know, they're talking about how the CPI was getting upwards to 8.1% and so on and so forth. And really, the Bank of Canada had to step in and take dramatic changes to hopefully get inflation out under control. I spoke about this in our last video. Economics 101 here is there's an inverse relationship between interest rates and inflation. When you're in a low interest rate environment, it's almost an economic law that inevitably there will be inflation. So when interest rates are low, inflation will be high. And so the way to correct it, if you increase interest rates, then inflation should follow suit and drop. And so that's what they've been counting on, but it really hasn't changed inflation all that much. And so much so that this is another release, October 26th, so only a couple of weeks ago, by the Bank of Canada, when they're explaining their most recent decision to increase by yet another 50 basis points. You know, the article goes on, but basically they conclude, given elevated inflation and inflation expectations, as well as ongoing demand pressures in the economy, the Governing Council expects that policy interest rates will need to rise further. So most economists, both at the Bank of Canada and at CMHC and elsewhere, most are expecting that this increase in inflation is not going away quickly, and it seems to be persisting longer than anyone anticipated. And Bank of Canada even sending a very clear message: we are likely to increase interest rates even further in the short term until they can get the ship turned around, until they can get inflation back under control. As long as inflation is still 6, 7, 8%, I think right now 6.9. Again, their target is between 1 and 3. We're really far off their benchmark rate, the benchmark or that target rate for inflation. So there's still a lot of work to be done. They're still going to keep upward pressure on interest rates, and we know then that this is going to continue to impact buyer affordability. So my message is, we're not out of the woods yet. Interest rates are likely to go up even further. This will continue to put pressure on buyers and affordability, that it's going to impact their ability to get approvals, and they're not going to be able to afford as much. Consequently, there's going to be less and less buyer demand. Again, supply and demand, people. When demand goes down, we can anticipate pricing may even go down further. So when we look at this curve and we look at the pricing, we've seen prices go down. It wouldn't shock me to see prices drop a little further. And the only time that's going to correct around is when interest rates start to stabilize. I think when consumers get a bit more confidence in the marketplace again, then we should hopefully see prices stabilize. Most of the economists are predicting the second half of 2023 is when they anticipate things to start to go on the rebound. But for the next 6 to 9 months, most economists are calling for a mild recession, and I'm encouraged by the word mild. I think Canada, especially Ottawa, is somewhat insulated from many of these market forces. Ottawa is a stable city, great employment, excellent place to live. So I hope we'll weather the storm a little bit better than some market centers. But there definitely is still some uncertainty left in the marketplace, and prices may be a little more volatile. Um, Hopefully they don't go down too much, or hopefully they can hold their value. But and then second half of 2023 is when most are optimistic that things will still start to go back on the up and up. Okay, so there is our market update for November 2022. I hope you enjoyed it. Give the video a thumbs up, share it with a friend, subscribe on YouTube if you haven't already. And as always, I'm Dave Robertson, your real estate professional for life.